Hello everyone, hope you're doing alright. Welcome back to this video. We are going to be touching on liquidity pools. A very interesting topic, and this is very important for you to understand because this is the basics of why our strategy works and how the market operates. Again, just a little reminder, if you have watched one ICT series, enrollments for my masterclass are opening up tomorrow. Very limited spots. So I mentioned in the beginning that the A to Z guide is for advanced traders as well. And if you don't think that the A to Z guide is for advanced traders, you are absolutely wrong. And I don't mean that in a rude way, but this A to Z guide is just as much for advanced traders as it is for beginner traders. Because if you watch these videos multiple times, you will find certain golden nuggets that most likely only advanced traders will pick up on. So if you're a beginner, that's great. Watch the videos, but maybe watch it a couple times. And when you are further on your journey to becoming a profitable trader, maybe watch the videos again, and then you'll pick up on new things. All right, now let's get into it right here. So liquidity pools. What are liquidity pools? Well, above highs. What are above highs? Above highs, there are breakout traders that are trying to buy price above highs, breakout traders. So when price breaks out above a high, they are trying to buy it with a buy stop. But there are also stop losses of people that are short in the market. Both the stop losses and the breakout traders use buy stops. So above price, above market price. So for example, market price is here. Above it are buy stops and below it are sell stops. So if we know that, that makes up liquidity. And now we need to find out, how does the majority of the market trade? The majority of the market, the majority of traders never gets past the simple patterns, right? They never get past the support and resistance, the trend lines, the head and shoulders patterns. Again, there's nothing wrong with it because people are profitable with these patterns. But I'm just trying to tell you, majority of the people, majority of the traders trade like that. And they are most of the time referred to as retail traders. Now, a retail trader, we are also retail traders, obviously, but retail concepts, or some people call them, I don't like to call them that, but they call them dumb money concepts. But again, that's something we can touch on later on. Now, if there needs to be a buyer for every seller, and there needs to be a seller for every buyer, who is actually providing that liquidity? Well, if we know majority of the people have sell stops right here below lows, then central banks, big institutions, etc., their orders will get filled below these lows because their orders are so big. They need some sort of liquidity to get into the market. So for all the sell stops, there will be buyers on the other side. So right here, once we do this and we come below a low, below a consolidation or whatever, I'll give you some real chart examples just in a few moments. Right here, institutions, central banks are buying those orders. And obviously the sell stop traders right here, the stop losses or the breakout traders are now trapped. So now if we want to take profits on those buys because central banks, institutions, etc., they have just bought, then who can we actually sell to? Well, we need someone that is willing to buy our positions. So we need liquidity again. Where is the liquidity? Above the highs. We now need buy stops. And above these highs is exactly where central banks, institutions are willing to take profit. So they are willing to sell to buyers. Who is the buyer here? Well, above highs, you'll typically see breakout traders, but also you'll see stop losses of people that were short in the market. So both of those positions are buy stops. So we are selling to buy stops. So right here, we are able to take profit, not we. The central banks and institutions are able to take profit. Now, of course, you need to understand central banks and institutions are not aiming for your liquidity. They are not aiming for your 2 lots that you put into the market. Absolutely not. They are aiming for huge funds. For example, you will hear the name turtle soups. What is a turtle soup? How was turtle soup invented? Do you recall, and maybe Google it, there is a book, The Turtle Traders. Those traders are called turtle traders, and they mainly follow the trend. So huge funds, etc. They mainly follow trends. They are trend followers. When the trend changes, they are hurting, they are bleeding. But when the trend continues, etc., they are mainly correct in their analysis. Those huge funds that are turtle traders, so they follow a trend like this. What does this make? A liquidity sweep, aka a turtle soup. That is where the name turtle soup comes from. So a turtle soup is a sweep of the turtle traders. All right, now this is the basics, the absolute basics and the necessities that you need to understand liquidity and to understand these liquidity pools, because obviously we can trade these, but we need some sort of logic behind it, because also that will comfort us. When we have some sort of logic behind stuff, our rational mind likes it more. That's why a lot of people are here in the first place. That's why a lot of people are trading SMC in the first place, because we need some sort of logical explaining for everything. And that is also detrimental. Let me tell you, that is not always a good thing, especially not in trading. And again, like I said, right, when you are placing a trade into the market, so you are trading on your broker and you're placing your 2 lots into the market, you're buying with 2 lots, you are not actually being targeted by the central banks or by the liquidity hunters, we can call them. No. And we don't actually need a lot of opposite liquidity to get out of the market as well, or to buy or to sell, because we are very small. We are very, very, very small. But again, that's something we'll dive into deeper later on. So let's dive into some real chart examples and how can we actually use this to our advantage. All right, so if we take a look right here, what do we see? Well, we see some sort of resistance right here, right? We have, if we are now thinking as retail traders, so retail concept traders, so support and resistance and trend line traders mainly. Then right here, we have resistance and we have some sort of support at the bottom right here. So this should hold a support. This support is now resistance right here. So what is below this? Below this line, there are sell stops. Those sell stops, we or central banks and institutions can buy those sell stops right here. They are getting bought. Where is now the opposite liquidity? The opposite liquidity is above these highs. Buy stops. So if we want to profit off of these buys right here, well, we will target opposite liquidity. We have bought, we are willing to sell above these highs. We are willing to sell, so we have a seller. Now we need a buyer. Who is willing to buy? The buy stops above that resistance. Again, that is people that were short here, or even short right here when this turned into resistance. Put your stop loss right here above this resistance. That stop loss is a buy stop, and willing breakout traders. So then right here, again, what are we targeting even further? Well, we have relatively equal highs right here. This is also resistance for support and resistance traders. So again, their stop loss might be above it, and we have breakout traders above it. There is liquidity above it. Then right here, if we take a look at this, we have some sort of trend line liquidity here, right? Trend line liquidity. And what do we have right here? We have a high above a high. What's above a high? There is liquidity. So here, above a high, we are tricking in buy stops. Those buy stops, who is willing to sell? We are willing to sell for those buy stops. And then now we are in a short position. What do we need next? If we are short and we are going lower, we want to, because that's the mechanics, how it works, we want to buy at a lower price eventually. All right, so what is this? This right here is support. What is below it? Sell stops. So we can pair our sells with sell stops. So we are able to take profit. Again, this might be a little bit overwhelming, so rewatch it a couple times. And once you do dive into the charts on your own, then this will make more sense. And then you can see, what are we now targeting? This trendline liquidity. There are willing buyers at the trendline liquidity. So we take that trendline liquidity out. All the stop losses are right here beneath those lows. That's where the liquidity is, and that's where we target. All right, now this is all fun, but how can we actually apply this to our trading? So let's take a look at how we can actually use this in our trading. All right, so if we take a look again at this example that we've used before on DAX right here, we had this monthly order block right here. Then if we drop down into the 4 hour, we had this breaker right here. What do we have here? We have relatively equal lows. They get swept before we have the real move. Now, when we retrace into the breaker, what are we leaving behind? We have relatively equal highs right here, and we have relatively equal highs right here. Those can be used as target for our trades and as extra confluences, because in trading, we are stacking up confluences all the time. Then if we drop down into the 5 minute in that 4 hour breaker, what do we actually see? Before we tap into the 4 hour breaker, we take liquidity. Then the next thing we are doing, we have right here, we have equal highs. We are taking them. Then right here, what is above price? Right here, equal highs, relatively equal highs. Where do we target? Right there, relatively equal highs get taken. Now, I want you to understand, this is very important because this is a mistake I've made in the past as well. Just because there is equal highs, just because there is trendline liquidity, doesn't mean price has to go there immediately. That is the wrong mindset. Just because we have equal lows right here doesn't mean price has to now trade back into it. So for example, right here, we had this liquidity, right? This is the consolidation high. Right here, we have a lot of consolidation. There are willing breakout traders above consolidations and below consolidations. So price will very often take one side of the consolidation first and then target the opposite side of the consolidation. Now, if we take one side of the consolidation, doesn't mean we can instantly target the opposite side. No, we need a reaction first. We need some sort of sign that price is telling us, yes, we want to target the opposite side. And it is very important to understand that this is done on the higher time frame. So if you're only trading liquidity pools on the lower time frame, you will confuse the absolute shit out of yourself. So right here, we are taking the highs of the consolidation, right? Breakout traders are trapped. Stop losses are taken. We are in a short position. Now, if central banks and institutions are truly selling above those highs, then they will not stay above those highs very long. So we will see displacement to the downside. And that is very important. And the same goes for if we are taking liquidity. So for example, this low, if we are taking liquidity below that low, and institutions and central banks, they want to get involved, then obviously price will not stay below that low very long because their orders are so big. So price will instantly move. These orders, these sell stops will instantly get bought. Boom, just like that. So we need to have some sort of rejection. Right here, we have a rejection, and then we can target the opposite side. And that is very important to understand. And a lot of people do not pay attention to that. And they think a high is getting taken and they are just shorting right here. Price is going higher and they are still short, and they are just taking loss after loss after loss after loss right here. And another loss, and price is just going higher. It isn't even showing signs of weakness, and it's just going higher, and people are just taking losses after loss after loss after loss. And that's not the right way to approach this. We need to have a logic behind what we're doing. And if institutions are truly selling above highs, then price will not stay long above those highs. And again, you need to understand, right? I'm making sort of a story right here. So I just told you that just because there's liquidity on the opposite side doesn't mean we are going to target it immediately. And then I just told you that if we are truly selling above highs and buying below lows, we need some sort of reaction. They are in harmony with each other. Because when we get that reaction, we can truly target the opposite side. And then we can truly target opposing liquidity. As in, we can truly target this trendline liquidity now. Because we have seen a reaction away when we swept a low. Very important to understand. Always react. Always react to what price is doing. All right, now the last thing I want you to understand is a liquidity sweep is different than a liquidity run. A run on liquidity is when we will continue lower. So for example, if we take a look right here, above this high, we just saw a sweep. A sweep is when we sweep liquidity right here above the highs and target opposing liquidity. Now a run on liquidity is when we keep running. So we don't sweep, we just keep going lower. So right here we have liquidity on the lows. So below the lows are liquidity. We keep running. We are not sweeping. We are running the liquidity right there. So it's going down and it's going to keep going down when we are running liquidity. All right, you are going to need to watch this video multiple times to understand it. And you are going to need to absolutely do the work on your own as well. So after this video, study equal highs, equal lows, trendline liquidity, study head and shoulder patterns. So look up the patterns and see how price is absolutely being manipulated and see how we are moving from one liquidity pool to the next liquidity pool. And in between those liquidity pools, what do we see? A breaker. We see some form of PD arrays that we went over. We see them holding right here until we take out the opposing liquidity pool. So again, do the work and you will understand it 100% completely. No worries. It just takes time. Again, a reminder, if you are a bit more advanced already, then the enrollments for my masterclass are open right now. So check that out if you are interested. And I'll see you at the live stream on Sunday. And if not, then I'll see you on Tuesday at the next video on the A to Z guide. All right. Thank you.